Hi guys, so we're back with the Chapter 7 lecture. So we left off last time on this slide talking about the different types of internal control deficiencies. And we'll be seeing this slide again later on today when we're talking through some different examples and how to classify them. But starting off today, we're going to talk through the steps in management's assessment process that they go through as part of 404A and the auditor's assessment process that they go through as part of 404B. So in terms of management's assessment process, they have these steps that they go through. And the first thing you'll notice here is it talks about how management must follow a top-down risk-based approach. And I'm gonna skip ahead a few slides and I'll skip back and forth a bit to explain this, because what I want to point out is here it says management has to follow a top-down risk-based approach, right? If we look here at the steps in the auditor's process, it says the auditor must follow a top-down risk-based approach. So I want to talk about this briefly because this top-down risk-based approach idea is essential to the process both of the auditor and the management when they're doing this 404A and 404B assessment of ICFR effectiveness. And the reason why it has to be this top-down risk-based approach is all because of how 404 started. And we'll talk briefly about this. But when 404 was first implemented, it was implemented using guidance in Auditing Standard 2 or AS2. And when auditors and management read AS2, their interpretation of it was that they needed to test every single control that the company had basically in its existence. So every single financial reporting control had to be tested equally. All right, equal time had to be devoted to it, equal energy had to be devoted to it. You get the idea. So we're testing everything. And that's part of why when 404 was initially implemented those first few years, 405, 06, 07, it was really expensive and people really hated it. All right, they were like, it makes no sense. We're just basically testing every control. There's no rhyme or reason to it. This is overkill, like regulatory overkill, yada, yada. So now what the regulators did is they put out AS5 or Auditing Standard 5. And the idea that AS5 put across was, hey, we're not saying you need to test every single control. And we're also not saying all controls should be treated as equal. Really what we're saying is when you're testing for control effectiveness, when you're going through and you're trying to understand the control environment, you should be taking this top-down risk-based approach to things, right? So what we want you to do is to start off and look at the main areas of risk in the business. Okay, so where are the potential risks for misstatement here? What are the accounts most at risk for misstatement? What are the locations most at risk for misstatement? And identify all those things first. And then what we want you to do is identify at least one key control for each of those misstatement risks. And those are really the controls you should be spending your time and energy testing, right? You shouldn't be just testing every single control under the sun that you can get your hands on. You should be taking a logical, measured approach to this and testing the controls that are really addressing the misstatement risks. Because honestly, that's what we care about. That's the point of all this, is we want good controls that are going to prevent and detect misstatements. So that's the point, and that's why you see throughout this top-down risk-based language in both the 404A section and down here when it talks about the auditor, you see that language again in the 404B section. Okay, so they're considering areas of financial reporting risk, they're considering those key locations, that are the most, risky and are the most material, right? Because it's material misstatement we're worried about. And then ultimately they'll evaluate the evidence. They need to consider their 5 COSO components. They need to also identify entity level controls. So this comes with doing this top-down risk-based approach. So first think about things at the entity level, things like tone at the top, like, do I have a good audit committee in place? Do I have a good board oversight in place? And then think down to those lower level controls. Of course, management has to document everything, especially all these processes. And part of why management's documentation is also a good thing is then the auditor can leverage it when they're performing their work, right? So it creates less work for the auditor. Really quick, your textbook has this 404A report, or an excerpt from a 404A report from Groupon. And this is a bad 404A report. So earlier when we had that example from Apple, that was a good, normal, standard 404A report. Okay, this is a bad one where they are disclosing material weaknesses in internal controls over financial reporting. And so if you read through this, you'll notice they're saying, okay, we concluded there's a material weakness. And here they're saying things like, we did not maintain financial statement close process and procedures that were adequately designed. As a result, we had to make a number of manual post-close adjustments, and we didn't maintain effective controls to make sure accounts were complete and accurate. And account reconciliations we didn't make sure they're properly performed, reviewed, or approved. And then down here is, we did not have adequate policies and procedures in place to assure timely, effective review of estimates, assumptions, and related reconciliations and analyses, including those related to customer refund reserves. So because of that, the original estimate disclosed on February 8th proved to be inadequate after we performed initial analysis. And you can tell kind of what happened here is February 8th was the date of the initial earnings release. We had talked before about this idea that companies release earnings before they release their 10K. Right? Usually there's a lag, maybe of a couple weeks, but they'll let their earnings come out early and they'll have usually an earnings call with analysts and things like that prior to that 10K release date. And for the most part, the audit is typically pretty much done by the earnings release date, and the auditor should be very comfortable with your earnings and your numbers on this day, the day earnings are released. And it is considered really, really bad if there are any adjustments made to the financial statements between the earnings release date and the 10K date. Even though the numbers in the earnings release date aren't technically audited, it's still considered really bad if you're making changes between those dates because you are releasing this to the public and people kind of take it as fact, even though it's not technically official yet. So you can tell here that they did have a change, and not only was it a change, it was a change in an account that impacted income, right? It was a reserve. So the other half of that would have been a cost account and it would have impacted income. So that's why they're having to go through this procedure and say they have a material weakness because there was this massive error included in their earnings release. And looking at this, you can also tell why 404A and 404B, in a sense, they are kind of a good thing and they do have kind of a good impact, right? Because if you imagine pre-404, as a shareholder external to Groupon, you would not have had any of this information. And I would argue this is material information, right? It's nice to have this information as somebody who's considering buying Groupon stock or selling Groupon stock. This is good information to have. Pre-404, you would have seen the number in the earnings release change in the 10K. And so you would have seen this adjustment, but you wouldn't see all this explanation as to why, and oh, we have a material weakness. It would have just kind of gone unsaid.